Hello, with me today I have James Dawes, Chief Financial Officer at 3i Infrastructure. Hi James, thanks very much for joining me today.
Hi.
To start with, could you please tell viewers what 3i Infrastructure is, what it does and how it generates returns for shareholders?
Of course, yes, so 3i Infrastructure is a London-listed investment trust. We invest in a diverse range of infrastructure companies. These are private companies, so you can't buy them on the stock exchange. And we're trying to deliver long-term sustainable returns to investors. So we have a return target, that's 8 to 10% per annum over the medium term. About half of that target comes through a dividend. So we have a progressive dividend policy, so it's been increasing every year since IPO. And the rest comes through capital appreciation, so and including any outperformance, that's typically through extra capital return.
Okay, so how involved are you in the running of the businesses that you invest in? Are you very hands-on or engage less frequently? Do you send teams in or just one or two individuals?
So we're on the board of all of the portfolio companies. So we're very, very active managers. It's a private equity style way of running the portfolio. But we're backing exceptional management teams. We're on the boards, as I say, so we partner with those management teams to drive strategy for the companies. And we will add capabilities to the board as we see appropriate. So we're meeting with them every week. Do we send teams in? Yes, there are about 5 or 6 people in our investment team working on each portfolio company. So it's very intensive. We're in touch with them every week. Typically there's monthly board meetings. We have monthly management accounts. So there's always stuff to be talking about with them.
Sure. The current portfolio is about 12 companies. Is that about right historically, or does that figure fluctuate at all?
So it does vary. I'd say it's about right. We don't want double that size. Equally, don't want half that size. We want to maintain a diversified portfolio. And given the number of team members that are involved in working with each of the portfolio companies and the size of the team we have, that's about right. But it does change. We do sell assets. That's a feature of our active management, is occasionally selling the right company at the right time, ideally through a competitive auction process, so we get extra returns through doing that, and then recycling the capital through new investments. So it'll go up a bit, it'll go down a bit, but it feels about the right size.
Well, it's interesting about how you exit portfolio holdings, because one might imagine it's not easy to decide that you want to get out. Who do you sell to? How does that process work?
So typically we're selling to other private company investors. So typically these are partnership funds, so infrastructure funds. Often they're much bigger than 3i Infrastructure itself. And they're building their own portfolios of private infrastructure companies. So it takes a while to realise a company. So you work with the management teams to construct a sort of next phase plan for the business, looking at how they're going to grow into the future. You have advisors appointed. You conduct due diligence exercises that you can give to potential to buyers, and then you run a competitive auction process that would typically have a number of rounds. And through that sort of right dynamic, and because you've picked the time to sell the asset, you can get an uplift on where you're currently valuing. As an example, we sold our investment in Attero in July last year for about 30% more than we'd valued it just the previous March. So that was through a proper exit sort of auction process.
Okay, you reported in your recent third quarter performance update that things have gone better than expected over the past year, and that you should beat your annual target return. Could you pick out some highlights that explain the outperformance?
Yes, I mean, so we're in the final quarter of the year now, so we've got good visibility on how the portfolio is performing, and it's performing very well overall. And some of the gratifyingly, the larger investments are particular highlights. So I can get into that in more detail in a second. But we had a very strong first half, so that gives us good visibility on outperforming for the year.
Okay, which ones would you pick out have pleased you?
Yeah, okay, well, TCR is a good example. That's our largest investment. That is a business that leases ground handling equipment to airlines and ground handling businesses. So that's all the kit that you see around an aeroplane when it's about to move. So it's essential kit, It's providing an essential service. The plane won't be able to take off if it doesn't have all the stuff around it. So it's fueling and ground power, sort of the steps onto the aeroplane, the baggage carts that load the bags onto the plane, all that equipment. And customers, we're finding, would rather lease or increasingly like to lease that equipment from TCR. TCR is the largest provider of this leasing service. And so it owns the kit and it makes sure that it's available, so it maintains it, and so that the customers don't have to worry about that. And it had a good COVID. So whereas the customers were having difficult time, obviously the air travel industry was largely shut for a little while. But TCR, given the nature of what it does, the customers expected that they would require this kit when they were able to fly again, so they hung on to the TCR service. And then since then, those customers are very keen to rent the equipment rather than own it themselves, because they obviously had a difficult time during COVID. So it's having a very strong time since COVID.
Okay, James, you've talked about TCR. Are there any other companies that you think viewers might be interested in?
Well, I think they're all interesting. These are real businesses with real employees that do very interesting things, and we encounter them in day-to-day life. But think of a UK example. We've got a portfolio company called Infra. Again, it's one of our largest portfolio companies. That generates electricity from methane gas that comes out of landfills. So it operates over a large number of landfill sites across the UK. In the corner of the plot, they'll have some gas engines which they burn the gas to generate electricity. And we've changed that company since we bought it back in 2016. So it's now more of a balanced renewable power developer. And it's rolling out solar power, so solar cells across the landfill sites. And alongside that, it's implementing some battery storage, which is a good balance against the solar for when the sun's not shining. So I think that's a fascinating company.
The shares have generated significant returns for investors since launch in 2007. They currently yield about 3.5%. Are you comfortable with recent performance? What are conditions like for the business currently? And have target companies become more or less expensive?
Yes, so the performance has been very strong since IPO, so it's been about 12% per annum since the company started. The FTSE 250, which we're a member of, has done about half that return, so around 6% in the same time period per annum. So yes, it's been strong performance. When the interest rate cycle changed and the interest rates started going up, we moved from trading at a premium to net asset value to trading at a small discount. So over the last year, for example, the share price has been broadly flat. So you know that we haven't seen the NAV performance translating into share price performance recently, but we would expect to see that much more strongly correlated in the near future. We're sort of at or close to the turn in the interest rate cycle now. So that change is in the past now.
So you expect that once rates do start to fall, possibly from mid-year around that sort of time, that to reflect more positively on the on that discount?
Possibly. I mean, that's what happened on the way up. But even if they stayed flat, we should see the NAV performance translating into share price performance.
And so when you're looking at target companies, how are valuations at the moment? Are target companies looking more expensive, or are there's some bargains to be had?
So we still see that for high quality infrastructure businesses with the sort of characteristics that we look like, so essential services, sort of good downside protection, these trends that can support them across economic cycles, these megatrends that I mentioned, that businesses like those are still very attractive. There's a lot of money in the private fund world looking to buy businesses of the sorts that are in our portfolio. So that's helped our valuations hold up in the last year. And so our sale of Atero in July was evidence of that. I think the market has slowed down, so it doesn't necessarily mean pricing's changed, but there may be fewer bidders at the moment. We're fully invested. In fact, we're drawn into our credit facility at the moment, so we don't need to make new investments. And indeed, we don't need to make new investments to deliver our return target as well of 8 to 10% per annum. So it's more of a buyer's market than a seller's market at the moment, but we don't have to buy things to hit what we're trying to achieve.
Sure. You're invested in companies driving the energy transition from fossil fuels to renewables, and amongst other megatrends as well. Will that particular trend will become an even greater focus over time, do you think?
So we want to maintain a diverse portfolio, so lots of different risks sort of balanced across the portfolio. So we're not trying to become a renewable power fund, for example. But if you think of the next couple of decades, a lot of investment needs to go into the energy transition. A lot of investment needs to go into digitalisation. So those are the two biggest themes today. So I do see that will continue.
Yeah, and you talked in the third quarter update about a number of attractive opportunities. Now, you said you don't have to invest at the moment, and you are fully invested. But when you mentioned the attractive opportunities, does that mean at some point in the future you've got your eye on some businesses that you'd like to bring into the portfolio?
Well, we're always looking at things, but the focus on our portfolio at the moment is potentially realising one or two companies that will help us pay off our credit facility. But the attractive opportunities are particularly through the existing portfolio companies. So TCR that I mentioned just now has bought an equipment services business off KLM, so based in Schiphol Airport. So that sort of thing, the bolt-on acquisitions, particularly through the current portfolio company, is an area of focus for us.
James Dawes, Chief Financial Officer at 3i Infrastructure. Thanks very much for joining me today.
Thank you very much.